Good day, everyone. Major averages jumped earlier this week, reversing downtrends in the case of the S&P 500, or moving to new closing highs in the case of the NASDAQ and related industries. But most of our stocks on our focus list, they do continue in their uptrends, as would be expected. I was going to say, but a lot of the low-risk entry points that we wrote about in prior focus lists have come and gone. Naturally, that's what you would hope to see, since you'd want those stocks to be at least performing or outperforming the major averages.
Hey, Dr. K, can I throw something in real quick? I just want to point out on Amazon, I shorted that one near the open because you had a 620 sell signal right here. You had already crossed on the MACD right here. Let me see if I can make that a little bigger. So, whoops. Yeah, those become irrelevant. Yeah, so you can see the cross on the moving averages, and the MACD lines had already crossed, and it's still going down. So you even had a little bit of a stretch here and a cross, and it never got above the 20 period. Usually if I see that, I'll either use the 20 period or I'll just cover into that and try to short again on a rally back up into the 20 period line. But you can see this is coming off of the gap up after the strong earnings. So it's not like it's necessarily off to the races. So in the pattern, what does the pattern look like? Yeah, so you can see we're trading. We'll see what happens, but that looks kind of negative. Anyways, carry on.
Yeah, like that's illustrative of keeping a fluid approach to the markets, because what in the longer run might be viewed as very bullish, you might be able to scalp some points, by going short, because nothing goes up in a straight line. We certainly saw that as the case of the VIX volatility model this last week. But nevertheless, while things have been looking good for equities and markets in general, it's never a time to get complacent. Reminds me of the year 2000, the first quarter, when people started to quit their jobs to start their own mutual fund, or rather hedge fund companies, because they just thought they'd figured out the markets, and the level of complacency was so extreme it was making me nervous. And I remember that with every dollar I made in that first quarter, because I was up well into the triple digits that first quarter alone by playing the biotechs, I was nervous as hell. And so I just internally, something in me said something's really wrong with this kind of setup, and it can't last. So, and that explains, I think, why we were, not just myself, but we were able to get out of the markets generally within 3 days of the March top in equities. But nevertheless, I wanted to say a few things about, this level of comfort has been driven largely by the Fed, which has been quite misleading, and that's no surprise, because they are politicians first and economists second, or I should say their mandate is to obey the greater picture. That is, it's not about curing and healing. It's about making sure people don't lose their heads, and they're going to mislead if necessary. In terms of the health of the economy. They've been going on about how things are turning a corner, and here's the evidence and such. And even if you take the evidence at face value, that is, even if you say, okay, these markers, these economic points of strength that they refer to are accurate, which really is very difficult to stomach, because there's so many flaws in the data, like the CPI, and the unemployment rate. But let's just take that for granted that the evidence is accurate. They still have been misleading, because things like the GDP, for instance, that came in at a meager 0.7% annual pace in the first 3 months of this year. And I'll get more into it in a moment, just in terms of how weak the economy is right now. I'm going to send a more comprehensive piece when the time is right, probably when the markets, if and when the markets start to show real signs of major tops or major cracks But in the meantime, I'll just give you a short run of what I'm viewing right now. I mean, the economy has very little to show since these trillions of Keynesian dollars have been spent since late 2008 when QE officially began. The effects weren't felt until the first quarter of 2009, and then we saw the beginning of the massive bull market, which still continues to this day. And a little historical overview is that the Fed's been undergoing numerous tightening cycles over the last many decades. It's a natural course for what they're designed to do. And so far in this tightening cycle, the Fed has tightened twice. But as I've said, it's on either false or misunderstood premises. I mean, for example, the Fed is tightening into this is the weakest economy since World War II, and that's measured by growth in nominal GDP. And today we saw further evidence of that weakness in GDP. It's also tightening into record levels of debt. I mean, we've gone over that a number of times, and that was all spawned by QE. And that suggests that even small changes in interest rates might have a much greater material impact than normal. They're also tightening into a monetary base reduction. Without getting too complicated here, we have laws like the Dodd-Frank that require banks to hold more liquid reserves than ever before, and that naturally increases monetary restraint. The short-long of it is that banks have less to lend struggling businesses or businesses that are the lifeblood of the economy. They don't have as much to lend, and actually the amount of lending is near all-time lows because of Dodd-Frank and other regulatory measures, which are crippling to struggling and resuscitating economies. And it's a great example of how regulation can stifle intended growth, since Dodd-Frank works against QE. So it's like the machinery at the Fed. There's all these missed signals. One hand's doing one thing, one hand's pushing while the other one's pulling, that they need to get that sorted out, because this is playing with people's livelihoods. The other thing that I was saying, that the Fed's also tightening into deteriorating key monetary variables, and such as the GDP. They're tightening into these variables that are heavily influenced by the Fed. And so any of these reasons could spur on another Great Recession, or something worse. We're at the lowest, to go into GDP a little more in more depth here, we're at the lowest annual economic growth rate of this expansion. This bull market that began in 2009, and we're in the second straight year of declining growth. Yet the Fed has the public believing that the GDP is on solid footing. But if you look at the facts, QE was launched at the end of 2008, and that allowed growth to recover by 2010 to some extent. But then growth sharply slowed again to the GDP was only at like 1.5% in 2011. Then it picked up slightly in 2012 because of continuing QE, but then slowed again in 2013, and that, of course, we all know that prompted the launch of renewed rounds of QE. So now in 2016, growth has slowed, in the last few quarters, growth has slowed once again. And today's evidence underscores that at 0.7%. So that would beg the question, why isn't the Fed adding rather than subtracting fiscal stimulus by lowering rates? Why is a mandate to hike rates, to continue to hike later this year? And the reason is simple. The level of rates are still at near record low levels despite the 2 rate hikes. So their hands are tied. We've said a number of times the Fed's painted themselves into a corner. They've got no choice but to continue their pro-interest rate hike agenda, even at potentially great cost to the stability of this very fragile economy. It wants to have, needs to have that interest rate fuel, call it fuel, so that when the next recession comes along, they'll have room to reduce rates. Right now, they really have no room for that. They have very little. The gas tank, the interest rate gas tank is almost still on empty. And the signs are there that the next recession might be closer than thought for those reasons I cited above. So then that also begs the question, well, why did the Fed paint itself into a corner? And I think the answer is that, these are unprecedented times, making policy outcome prediction a near impossibility. They reduced rates, which normally works under most situations, but they've applied it to an extreme situation. And so consequently, they found themselves doing the wrong thing with the wrong time. And global central banks have mimicked all of this. They've even gone negative, NIRP policies. So as we've said before, at no time in history has there been a soft landing when debt levels have been this extreme. And this has been echoed by Alan Greenspan, Jim Rogers, Ed Seykota, and so on. And at any rate, on that sobering note, Gil can give you his view on the markets.
I just IM'd you a question from somebody, if you could answer that.
Okay, the question from attendee: if GDP is weak, how does one reconcile that earnings backed by revenues have been good? Why the disconnect? Well, first of all, that is one aspect of first of all, QE is helping, obviously, a lot of these companies.
Well, I would say, Dr. K, I would say a lot of companies are able to bolster earnings by buying back stock and using debt to buy back stock. And you've seen that in a lot of S&P companies. So S&P earnings have been good, but I don't think that the story across the board with respect to individual stocks is necessarily showing strong earnings growth on a broad level. I mean, you see, were Amazon's numbers all that good today? I mean,
well, yeah, but no, what you're saying is right. That it's a QE factor still. This is all QE creates a lot of different bubbles
right.
that are unnatural, and it allows companies to do just that, to take different operations that they normally wouldn't have the ability to do, and so debt levels at companies consequently. Well, that's not the right word. Let's just say because companies are able to do things they normally wouldn't under non-QE operations, it's creating artificial bubbles such as earnings that are, you could argue, inflated earnings and revenues. Now, if you were to take the QE punch bowl away, those earnings would be nowhere what we're seeing right now. And keep in mind that even though the U.S. reduced QE or eliminated QE some time ago, the Bank of Japan and the European Central Bank are still printing in full measure, and all that excess is going to find its way into the tallest standing midget, which is the U.S. market and stocks therein.
I heard somebody last week talking about how if you take despite the fact that the Fed is supposedly tightening, if you take all of the central banks around the globe and you tally up the QE that they're pumping in so far this year, they're actually pumping in QE at the fastest rate over the last 8 years, which I thought was kind of interesting. So it really shows how they're propping up a lot of this stuff, and all that does in the end is create a massive bubble. So
right, and the bubbles are quite substantial. That's why when some of these luminaries I mentioned, like Jim Rogers and Alan Greenspan, Ed Seykota, and so forth, when they say that 2008 was just a trial, a pre-trial compared to the real thing, this impending collapse might very well make 2008 look relatively minor. But I don't want to say that as the sky is falling, because there are factors that can offset the magnitude of any sort of collapse, and one of the big key factors are exponentially growing technologies, which they're not slowing down, they're not going to slow down, and time and time again we've seen how they have a dramatic impact in a positive direction. So I think that will be a counterbalance to a big upset from all this QE money printing that's gone on over the last several years. So yeah, don't go around saying the sky is falling. I think that the sky doesn't ever fall because there always are countermeasures that are being put in place, and that is a dynamic process that has taken place in every single instance, every single so-called crisis or say crisis situation real crisis situation that's taken place over the last couple, since this nation was born. And if you look at a very long-term chart of equities since this is going back 150 years or longer, you'll see that humanity is very ingenious and inventive, so that when all seems lost, lo and behold, the market will find a very deep floor and start to recover. And my view on that, it stays fairly optimistic. And I think that until maybe AI takes complete command and control, I think that humanity will continue its upward trajectory, even though it will be a very sloppy one.
Anyways, okay, so where were we? Oh, you wanted to know what I think about the market? Let's see. I don't know. I would say, who cares what I think? But anyways, we're kind of extended here. You can see the NASDAQ coming off of the lows near the 50-day moving average has gone. How many percent is that, Dr. K? Is that like 5%, 6%, something? I don't know. Yeah, about that.
Yeah.
And it's gone through the 6,000 level, which gets a lot of people cheering. But I haven't seen any NASDAQ 6,000 hats, coffee mugs, or martini glasses around. So I guess it's not that big of a deal. But in any case, with the market going up, everything looks wonderful. And the one thing to note, though, is that you see the NASDAQ is what's driving everything. And a lot of it's been these big stock NASDAQ names. And, of course, Amazon, you got today Google is up on earnings, but maybe it's starting to stall out here. I'll tell you what, something I'm shorting right now, I'm actually shorted at like 44.60. is Grub, which actually was a long yesterday on the, just going to sidetrack really quickly here, a long yesterday on the bottom fishing Bible gap up. You had a lot of shorts in it. So what I watch for is when they start giving way, if I'm playing that BFBGU to the long side, when do I want to flip, if at all? But let's just take a quick look at this on the 620. You can see you're just starting to get a 620 sell signal. Yesterday it looked like you would get one. This is yesterday, and right up in here I was noticing this, but I was watching this thing and I thought, you know what, this thing is going to go higher. So go along there and you get another couple of bucks out of it this morning. So but it seems to have run out of gas, and I think thematically it's still vulnerable based on the competition. But I guess the earnings were good enough to just squeeze a huge number of shorts in the stock. That's why I'd never hold it into earnings, because you get a big gap up, and instead of it being, instead of it chopping you up, you can either go long the thing if you play it right, or you can get short into the rally at some point. But you can see you never had a 620 sell signal yesterday, so there was never really any justification to short it. You could have hit the MACD stretch here, which I did actually, but you could see that once you got this going and this sort of bottoms out here and it's just going tight sideways, and right in here you can kind of see it's not going to give it up, so you just flip and go long, and you can catch a trade there. And I find that's what this market is mostly about. There are some stocks continuing to trend higher that act pretty good. Obviously Facebook just keeps going, and that's what's been helping to drive the market. That's the 620. There's the daily chart. Apple is another one that's been acting well. Let's see, Microsoft got tagged. In fact, Apple looks like it's setting up to move higher. Microsoft got tagged yesterday or today after earnings. I guess I thought it gapped down. I guess it gapped down and then gapped up this morning. Gapped up yesterday after the report, or gapped down and then gapped up this morning, and now it's reversing. So you get a lot of funky action like this. I was watching this Cavium yesterday. They came out with earnings. It first broke down, or it opened up and then broke down to 68 and then turned around and rallied back up and closed higher than where it opened, but just barely. And then today it's getting whacked. So, it's that kind of a market, where things will look good and then they'll get whacked and then they'll turn around. Look at Netflix is another big stock NASDAQ name that was looking pretty grim right after earnings, okay? But as I pointed out last week, it had undercut this low. So as soon as it got above the 50-day moving average, I can invoke the moving average undercut and rally move, which is basically the sort of a corollary to what I've also called the 50-day moving average violation fakeout, because it also violated the 50-day moving average here, but that just undercuts the low and fakes everybody out, and then it turns back to the upside. So what I've noticed a lot of also in this market is that this so-called 50-day moving average violation rule doesn't work most of the time. Here's one. Here's the one that was on our focus list, and we took it off on the basis of 50-day moving average violation. And what happens? Look at this thing just turned around and launched another 20% from the 50-day line. So that, that's what you deal with in this market, and you get funky moves at various times when things look pretty grim, and things will just turn around and rally. So I'm always looking for these undercut and rally situations. But anyways, that's what's been driving the NASDAQ. The Russell's been, is this right? Yeah, the Russell's trying to help, but notice how it's just barely breaking out. Now it's starting to fail on the breakout, so that might be a problem. And meanwhile, you got the NYSE-based indexes tried to break out. In fact, you can see that, like with the S&P, well, even with the New York composite, NYSE composite, you had a trend line breakout here, and now you're rolling back in. So we'll see if that holds. But the S&P looks similar. So it's kind of just running up against the highs here, and maybe it just backs and fills for a while. But one of the issues I have with the Trump administration right now is it's mostly they're over-promising and under-delivering. So I think the proposal, the tax proposal that was put out, what was it, Wednesday or Thursday? What day was that?
Wednesday.
Wednesday,
On
yeah.
Wednesday.
I mean, that sounded really impressive, although I have to admit, I didn't, as a California resident, I didn't like the fact that they're going to get rid of the ability I have to deduct my California state taxes from my federal income, gross income to, or net income. No, wait, gross income. I don't know. I'm not an accountant. Gross income, to any accountants out there? Gross income would be the total amount I made, and the net income would be, or adjusted income would be what you have, what's actually taxed. So, I pay a large amount. 13%, I think, is the top rate I pay on California taxes, which really sucks. And now they're telling me, or Trump is saying that he's going to eliminate that deduction, which doesn't really thrill me. But my general impression of that whole thing was that it's another example of they're promising a lot, and we'll see what we get. In some twisted way, I'm almost hoping they don't get it, because I think I take a bigger hit losing the deduction on California state taxes. Of course, there is the argument that other states with lower tax rates subsidize California, which may be true. I think California should lower their rates, period. Anyways, so the market is, you got the Dow trying to hang in here. So maybe if you saw a breakout in here by the Dow or the S&P, that might be constructive. So, but right now it's sort of a narrow market. You had some help from the smaller names, probably the financials earlier in the week, and now they're backing down. But I find the financials oftentimes can be shorted at resistance. Here's J.P. Morgan, which could have been shorted up here on this rally. You basically have a let's see. You have a breakout in here that has failed. So you run up there, and so you failed here. You rally into the 15-day and the 20-day, and you roll over. So this is a short point. Now you could have tried shorting it at the opening. I guess that would be on Monday, but that wouldn't have gotten you anywhere, and you probably would have been, you either didn't get a 620 sell signal, or you would have been pushed out of it, because then you rally up to the 50-day, and now that becomes a short sell point, and it's starting to come in. So I don't know if this is going to try and set up again and break out. That's always a possibility, because remember, like I was saying just a little while ago, in this market, when things look really ugly, that's when they'll probably turn back to the upside. And you can actually see that it was trying to get above the 10-day and the 20-day line here, and just building this little bear flag. So it looks like it's going to break for the 200-day line, but that's not what happens. It breaks for the 50-day and fakes everybody out, and starts to run into resistance up there. So what are some other financials? Throw some at me. Goldman Sachs, another one. You undercut the slow. Look like you're headed for the 200-day and the 40-week line, but you never quite get there, and you turn around on the undercut and rally, and now you're back at the 20-day line. So is this going to push higher to the 50-day, or is it going to roll over here? I don't know. I'd watch these closely, though, because I think the financials rallying earlier was predicated on the idea that the Fed was going to be raising rates consistently throughout the year. What were they talking about, Dr. K? Like 3 to 4 rate increases, something like that?
3 hikes. They were going for 3 hikes.
Yeah, okay. So, and with this GDP number, you can see the economy still sucks. There's nothing, it's not growing. And when you consider the fact that the GDP number is inflated because the government underestimates or underreports inflation, then the GDP number by definition is higher than it would be if they were using real inflation. So for all you know, we're actually contracting here. And so despite all of the optimism about Trump's policies and whatnot, it's mostly a lot of hot air and nothing really showing up in the first quarter of this year. Maybe that changes as we move along. So somebody's, we got some questions for you. Here you go. Dr. K, it is tiring to hear the same story every week. Time is changing and what yesterday was true may be obsolete today. Sorry to say that like this, but I think about joining the conference 15 minutes later in the future. I think you have that option. But yeah, I mean, what happened in the past maybe isn't so relevant anymore. I certainly don't use it as a predictor of the present, and a lot of the techniques that we use today are not the same sorts of techniques that I would use back in the 90s. So what were you talking about in the past, Dr. K? Were you trying to draw
I'm not sure. Can you be more specific about, I mean, you know, we have talked about how the Fed is, you know, Fed speak, and a lot of this data is erroneous, and you know, you just outlined one way that the GDP numbers are inflated. Therefore, we could actually already be in recession. If we are indeed, I think we are. I think we are. That 0.7% figure is actually would be taken negative if you factor in the inflation rate.
Inflation, right?
Slightly negative.
Yeah.
And,
so I mean, I don't understand what the question is. Maybe
the fact is that the point is that we're going to new highs, and you know, we got a strong focus list out there. You know, we are fluid in terms of what the markets are feeding us. Right. We don't care about political speak and any of that nonsense.
Yeah, maybe what the comment really means is that a diatribe about the macro picture isn't as useful as getting down to business on individual stocks. And I would say that's a valid point, because macro pictures don't do you any good. It's always about what's happening with individuals. And the whole point, yeah, if you want to skip the first 10 minutes of the webinar, you can do that.
You know, the whole point of bringing up, you know, the issue I did today is that a lot of people, I get a lot of inboxes sometimes throughout different media channels, and people start to easily get complacent. I've seen this pattern again and again. I mean, the most prominent one was in 1999, well, through the late 90s. And people just fail to keep their eye on the ball because making money, I guess, for them starts to become very easy. And you got to avoid that pitfall. And one way is to just keep a cognizant awareness that there are some serious problems under the hood. So, you know, if that is what it takes to prevent a trader from getting lazy and complacent and thinking, oh, it's, you know, everything's going to new highs, and you know, this cycle repeats, by the way. You know, this mentality happened in 1987 before the big crash. I remember that brokers started to tell their clients the market can't go down anymore. Then the same thing was repeated in 1999 with all the new technology. It was said that all the economic cycles would now be, let's say the volatility would be taken out of the equation so that you wouldn't get these recessions anymore. I mean, a lot of crazy claims. But people start to believe it when their trading accounts start to show great profits, you know. And right now we're in what year is this in this aging bull market? I mean, it started in 2009, so we're in the ninth year of a very aging bull market. And yeah, so it is.
Anyways, okay, we don't need to keep going on to belabor that point. So I want to get back to what's going on with stocks, if I might.
Yeah, that's where the money's going to be.
Real quickly, some people say, I like Dr. K's speech in the beginning. It keeps me always thinking and knowing it is just a matter of time before realization hits. Yeah, it's a matter of time. But again, watch the stocks. And I would say I find opportunities on both sides of the market currently. And there are some decent trades. If you're alert to them, you can catch some nice moves. This was a good one earlier in the week. Whoops. Applied Optoelectronics. Coming up, you notice there's a... let's see, 1, 2, 3, 4, 5. Yeah, there is a, I don't know if I mentioned this last week, but there is a bottom fishing pocket pivot on Friday of last week. I think we did our webinar on Thursday. So that was a bottom fishing one, but it hung out. And what I'm watching here is, again, what am I looking for? I'm looking for the moving average undercut and rally. So the stock undercuts the moving average and gets back above the 50. I go long, so you get a couple of bucks out of it. Now it's hanging along the 50-day line. You got to wonder, is this thing going to pop off of the 50-day line and come out of here, as we've seen a whole bunch of other stocks do? And that's one thing to keep in mind. So maybe it's viable here along the 50-day, using the 50-day line at, what is it at, like 48, something like that, as your stop. The other thing here is on a fractal basis, it looks a little head and shoulders-y. So it could go either way. So you better, if you're playing with this one, you could try it long, but be ready to move with it either way. And I find myself doing that with a lot of these stocks. So Netflix is definitely one of those.
This is a good example of, it's a very low risk entry point. In this case, I would keep your stop real tight. You could keep it, say, at the low of the low of April 26th. So that would be Wednesday. That would be 46.75. So that would be about a 4% risk. On the other hand, you could keep your stop extra tight and just keep it at the 50-day, which is at 48.11. In other words, with the markets heading higher as they have, this thing, you really don't want to give this thing much room at all. You want to say, okay, well, it had that gap up a couple weeks ago, and therefore it should follow. It should follow through on that gap up, and given the way the markets have been reacting or acting this week, this thing should make a move to the upside without really any give back.
However, if it breaks below the 50-day line, it could morph back into a short. Earnings show up, I think, in the next few days. So Dow's coming off a little bit. I think we're susceptible to a pullback. That's what I think. This Amazon is at 933.52. It's been going lower. It's not really finding a floor yet. Did what? You got a low of 931.55. You're a couple of bucks, which is nothing above that. So that looks kind of feeble. But someone's asking, what does unwinding the Fed balance sheet actually mean? Well, you know that they bought up, I think it's what, $4 trillion worth of bonds to liquefy the markets back, or they've been doing it over the past few years under their various QE programs, or bond buying programs. So now they have to sell those at some point. So unwinding the balance sheet means they got to go into the markets and sell those bonds. And it seems to me when you have the ECB, the European Central Bank, talking about continuing their QE activities and wanting to buy corporate bonds, well, that kind of leaves the Fed a little opportunity here to dump some, to sell into the rally, so dump some into the rally here with the other banks around the globe pumping in record rates. So I pointed out earlier that I heard last week that somebody was talking about how much global central banks have pumped in so far this year, and it's at the highest pace over the last 9 years. So why wouldn't the Fed, I was thinking, take advantage of that and sell into it? Anyways.
That's going to be another headwind for normal upside progress. I mean, this uptrend we've been in is nowhere near the mark of a healthy uptrend. It's a baby stepping one, and you can also see that in the lack of, say, NVIDIA-style names that break out and then go the distance. It's nowhere near what it was in the past. So, these are just all markers that they're yellow flags that one should be aware of. And of course, that goes into our buying and selling techniques. Back in the 90s, you don't sell into strength, you ride it. But in the last few years, the best thing to do is to take profits when you have them in context with a stock's chart.
Let's see. Some other comments say, someone says, I make sure I'm always on time so I can hear Dr. K babble about the market. Okay, that's good. Somebody's saying 620 signal, 6 and 20 SMAs. If you're new to this, the 620 chart, you can go look at it on the facts, but it's basically just a 5-minute chart that I use as a tool for guiding my entries and exits on shorts and longs. So, I'm not going to get into a big class on it right now. Let's see, where was I? This now is, I noticed, back up on the day. It undercut the low here, so you want to watch when that happens. Sometimes you get a 620 turn on it, and so now it's back up on the day. Dow's off 28 now. So someone's saying ALKS shook out. So why do I care? It doesn't look like it wants to go anywhere. It's just chopping. Anyways, but perhaps another example of crazy action. But you know, you had an undercut, a double undercut and rally. Look at that. You undercut this low, you undercut this low, and then you rallied. So if you're a hotshot day trader, you could have picked that off. Who knows what it does now, but it's just chopping sideways. Let's see. What are the names on our watch list or the focus list doing? Let's take a look. Just 1 second here while I pull this up. Well, Amazon we looked at. BABA has been cruising higher, and this stock's actually been acting pretty well, but they come out with earnings next week, so we'll see what happens there. But nothing really to do in terms of entry points on that. Baozun is sitting right above the 50-day moving average. It almost seems like, let's see, what's our volume rate this morning? Running about minus 5.5%, so pretty, it's not really drying up sharply, but it is running, it is declining on the sell side, you notice, along the 50-day line. So maybe it pops. They come out with earnings, on May 22nd. Let's see. Chemours or Chemours or whatever, continuing higher. So, you know, we pointed out in this morning's pre-market pulse that a lot of these names are extended, so there's nothing really in a buyable position. Maybe Baozun would be in a buyable position, but it's a little funky. We've seen that thing, you know, here's Coherent continuing higher. A lot of these look the same. Facebook we looked at continuing higher. JD.com is finally pulling back a little bit on an outside reversal, and that thing's just been going higher. So, you know, it's sort of entitled to that, I suppose. This MKSI has been off the list, but I just marvel at the fact that it's turned around and gone higher. Momo's up here, and I'm not going to buy it up here. There was a trading opportunity, though, if you were aware of it, on that would be Wednesday. You undercut this low and the 20-day moving average, and you flip back to the upside. There was some rumor around about an investigation. I don't know. You know, and whenever somebody hears about an investigation of one of these Chinese companies, there have been more than a few of these that have blown up. So when you start hearing that, you get a little bit paranoid. So it caused it to gap down in the morning, but then it's just an undercut and rally. So I think this is like 36.26 right here. So once it got above, you know, and the point I'd make with all of these undercut and rally type of setups on the long side, if it's an undercut and rally off of a prior low, then your entry point is the prior low. And what's your selling guide? The prior low. So you don't need to add 3 points and all this other gobbledygook and baloney that the Can Slim people like to tell people on the shakeout-plus-X rule, which is a bunch of garbage as far as I'm concerned. All you need is a shakeout and undercut, and then you try and gauge it from there. So, and same thing goes with a undercut and rally of a moving average. So, for example, let's go to Netflix. And, you know, this keeps things very simple. You know, it got back above the 50-day on Monday, and I noticed it sat there. The market was up pretty big, but it was acting okay. And, you know, not every stock is going to rally when the market's running. So you're going to get periods where some stocks will hang out or basically bide their time or whatever, and that's what Netflix did on Monday. And the volume dried up, so I thought that you could just enter it right there, use a 50-day as your stop, and bingo, you get the gap up the next day on news that they're partnering up with Baidu to get into the Chinese market. I've heard incrementally it doesn't mean much for revenue, but from a symbolic standpoint, it looks pretty good, and so far it's holding the breakout. Unfortunately, there's not a lot of upside from the breakout. The place to be buying was on the 50-day, and you got the nice move from there. And now we'll see what it does. But it's holding up okay. Snap, snapping along. You've had 1, 2, 3 5-day pocket pivots in a row. I don't know if anybody can see those. I think they're, let's see, one of them might qualify. No, I don't think they're, but there's 3 here, or actually pocket pivot, 5-day pocket pivot volume signatures. One here, one here, one here. Is it working on a third? It may run into some overhead right here and roll back before earnings. I don't know if it's going to keep going ahead of earnings on May 10th, but it's a couple of weeks away, and it has been squeezing the short. So I've actually been playing this on both sides over the last couple of weeks, or I would say over the month of April, short and long, and short and long. And it seems to wiggle around enough to work. So not like you're making huge money, they're just scalps. But and even if you bought some of the stock off of, say, 21, you're up what, 6-7%. So, and if you have a 25% position, that's going to add 1 or 2% to your portfolio, which is not anything to get excited about. The trick in making big money is to be able to have big positions running like mad for you. So, and that's a little difficult to do. Square is one that's been acting pretty well. The place to buy it has been along the 20-day line when it looks weak and ugly. And you might even notice that it did kiss the 10-week moving average last week. So that could have been an entry point too off the weekly chart. But you guys all see that? But now it's broken out, and it's a pocket. You're running out of gas here. This is a pocket pivot volume signature here on the breakout. Now it's rolling back in. Earnings are due on what, the 3rd next week? What is that, next Wednesday? Yeah. So, you know, what are you going to do? If you own it lower, you can hang out if you think you have enough cushion. Otherwise, I don't think I'd be trying to buy any of these ahead of earnings unless you're going to gamble on earnings roulette. So, and that is up to each individual to determine if that's what they want to do. Personally, I just stay out of the way, long or short. I find you're going to miss those gap ups once in a while, but I think the pain is too much to take when they get hit. And you know, I think in this market you want to operate according to the 3 golden rules of investing, which are number 1, don't lose money, number 2, don't lose money, and number 3, don't lose money. So I find that in the old days, my style was such that I could afford to drop 20-30% because I could come back really quickly. If that happens these days, it's not so easy to make back. So I try to keep things very tight, and part of that is not playing earnings roulette. Okay, so, but you know, if you've got a lot of money to burn, then and you like gambling, you can either go to Vegas or you play earnings roulette. So there you go. Other options are to buy options. So. Notice Tesla's hanging tight along the 10-day. That looks pretty good. I mean, it almost looks viable at the 10-day every time it pulls in, and it has been. So whether this thing's going to get moving through the $300 price level, because so far it hasn't really lived up to Livermore's rule where he was looking for 10-15%. We've been putting out a series of articles, and we're going to keep going looking at examples of these. And you know, some people came back to us with question like, you know, what are the stats on these patterns? Well, you know, I think a lot of people miss the idea that you can be right half the time. A setup can work half the time or even a third of the time, and you can still make a ton of money. And so people, they get sucked into this idea, and this is something we talked about in our second book, which I think was In the Cockpit with the O'Neill Disciples, something like that, where we talked about the need for certainty. People want to operate with certainty, and so they want a statistical probability of what this pattern is going to be. That's like the myth of the high tide flag, right? That somehow the high tide flag is some predictor of amazing upside, and people want that. It's like 90% of high tide flags have tripled from there, and so they think everyone's going to work the same. But the reality is, whatever the stats are for a particular setup, it doesn't tell you anything about that particular setup unless you're operating according to strict risk management rules, and that is buying at the setup at the proper spot. So in other words, with Tesla, you're trying to buy it as close to the $300 price level, and then use a tight stop from there. It may work, it may not. You can see in Tesla's case, you need to use a couple 3% of porosity on your selling guide because it tends to drop 2-3% below, and then now it's trying to get out of here, and it may not get out of here until after earnings. So embrace the uncertainty, says somebody. That's from Mark Douglas's Trading in the Zone. Yeah, and you have to embrace uncertainty. But it's amazing to me how IBD has done a great job of selling people on this mythology of certain patterns having certain probabilities of working, or 8 out of 10 stocks will do this. But the problem is they studied 10 stocks, you know, to come up with that statistical certainty, and it doesn't exist. But if you know that a certain pattern has at least a 1/3 chance, maybe even a 1 in 4 chance of producing a big gain while allowing you to keep a tight stop. So in other words, a move up through the century mark, maybe it's going to go to 350 in a hurry or in a jiffy, as Livermore said in Reminiscences of a Stock Operator. Maybe it isn't. Maybe it's going to fail. But at least if you can buy it there, you expose yourself to that potentiality while at the same time being able to control your risk by using the $300 level as your selling guide and as a tight selling guide, 2 to 3% downside. So that's pretty tight, and a lot better than 7 to 8 as Can Slim would prescribe. In any
Also,
case, you can see.
I would add.
Go ahead.
I would add that Bernard Baruch, the legendary Bernard Baruch, always said that the most meaningless statistic is success rate of your trades when it comes to making money. And I had a year where that really, was underscored, where my success rate was under 20%. Less than 1 out of 5 trades was profitable, but I was still up over 100%. I still did a triple-digit year. And it comes down to how you position size, how you conduct your sell stops, your risk management. Gil's saying, don't lose money, don't lose money, don't lose money. Ed Seykota has always said, the 3 most important rules are risk management, risk management, risk management. So, the nice thing about, what doesn't kill you makes you stronger, and that is these last several years have spawned techniques such as the voodoo volume dry up buy points, which, have incredibly low risk. I mean, I think that's really ideal for a risk-averse investor who does not want to risk more than 2 to 3% on a trade. And there's been plenty of those stocks that have presented themselves, and I would imagine would continue to. And the nice thing about these rules is that they still stand in prior decades, like the 80s and the 90s, when the dynamic in the markets was dramatically different. But the principle still holds. And so, when you keep your risk to a minimum, it's almost inevitable that your outcome should be profitable. It's just a question of the magnitude.
Anyways, so what else is looking good? We've got Snap we looked at. TTD is sitting here, and it's trying to get above its 50-day, but not happening. It could be building a new base, but I think they come out with earnings in the next few days. Let me see here. 5/18, so middle of May, basically. And then Viva has been hopping and bopping along. This thing acts well, but the last buy point I think was along the 20-day line back in here. So you notice we had Cat. I mean, it seems like some of the best moves occur after earnings. So you had Cat had a big viable gap up. We saw CSX Corp or Rail had a viable gap up, but not really going anywhere. Meanwhile, Union Pacific moved in sympathy, but it's kind of starting to back down. And what other ones? Like Cat, related to Cat would be Deere, which broke out, and now it's just dropped back into its base. Cummins Engine is another one. Tried to get out of here, but just got above the 50-day, so we'll see what happens. I don't think, do they have earnings anytime soon?
CMI.
I think it's like next week, yeah. So some of these, so maybe they rally and break out and run to the moon. I don't know, but it's weird that you're seeing these cyclicals, industrials. Now, Bill O'Neill used to tell me that when you're late in the cycle, you'll start to see the cyclicals and industrials start to break out, the capital good stocks. So maybe that's what we're seeing.
Well, we are late in the cycle.
When you
and CMI comes out on May 2nd, so that's Tuesday.
What?
CMI comes out Tuesday.
Okay. Someone's asking, when you review BSUN from the focus list and point out the wedging appearance, I don't think I talked about wedging appearance. Oh, are you talking about, I wouldn't get to, what happens here is you break through the 50-day line and then you rally back up to the line and volumes decline. So it's wedging up into the 50-day. Now it holds tight, and that helps to correct that little wedging action. So if you see the wedging action, you kind of get a sense that it's probably going to run into resistance to the 50-day line and then try to back down. You want to watch and see how it corrects that wedging action. Wedging action in and of itself isn't necessarily bad and doesn't mean it's going to fail right away. And it can be corrected if the stock puts some time in going sideways in volume. And you can see volume on the sell side is dried up relative to volume on the buy side of this thing. So that's what we're talking about. Airgain. Oh, this is a voodoo trade. I think it's just hanging along the 50-day line. I think if you take a small position into earnings, 5% or less, it might come out of here just because it's been beaten down so much. Just what it looks like on a weekly chart. Some other ones I was looking at, I like the Mule. That one worked. You got, if you bought it along here, along 22, you get a buck and change, which is about a 5% move, so you can have a party over that. But that's a sort of a one-point wonder trade that I'll take if I can get it. What was the other one I was looking at? in that report. Help me out, you guys. I forgot. SND. Thank you. That was actually good for a trade too. Could have bought it here in the mid-13s, and you would have gotten about 7-8% out of it. And it's relatively liquid, so isn't it? Yeah, 740,000 shares. But it's tied to this, so you kind of got to watch the group. And this has undercut some lows, but it's not going anywhere, so maybe it's going to roll over. And, you know, with Trump today, he was signing some presidential order opening up the offshore areas to, I noticed Grub is pushing to a lower low now, 43.89 on the bid, so I'm going to hang with my short on that. So there, you know, that's a long yesterday, it's a short today, so, you know, that's basically what's going on. And one of the things that's kind of driving me nuts this year is I can't really seem to get anything big going. If I think back, the Tesla I bought back in January, if I just bought 100% position there and sat with it, I'd be up big. But it seems like every time I get some cushion and I try to get a little more aggressive, boom, I'll get hit with something. And it's just hard to make big upside progress. So unless you sit, and that's a little bit difficult and it's difficult to do in this environment when you're so news-oriented. You know, something could happen tomorrow. North Korea could nuke one of our carriers and all hell breaks loose, and who knows. Just like over the weekend, you know, I didn't think the French election was such a big deal. Apparently it was. And anyway, UA, what about it? I don't know. You're gonna asking me if you should buy it? I don't know. Is it going to turn around? I don't know. If you caught it yesterday morning on the opening, you could have traded it as a BGU, and I guess, you know, the low at 19 bucks would be your out point. So Grub is going all the way back to 36. Yeah, 43.86 on the bid. Can you guys, like, can some of you short it some more and knock it down for me? So take it down to 43, and I'll buy some from you. Anyways, let's see.
You know, the problem with Grub, the business model, is that there's no barrier to entry, and there's tons of competitors that have joined the space, namely Amazon, among others.
Chow Now. So, I like Chow Now. That's the one that all the restaurants around here are using. And
yeah, I mean, they're all good. I've used a few of these, and they're all exceptionally good at what they do. But then, you know, it's a very easy business model to set up. So I don't see why Grub should be. I mean, if you look at the long-term chart, it's really gone nowhere. You know, since it was new issued at 26, gapped up to 40, and here we are, what, 3 years later, and it's at 44. So, you know, I think it's got a lot of headwinds in terms of competition. I think Amazon's going to dominate the space, by the way.
Yeah, I would agree with you. So, but I think you got a ton of shorts in this turkey, and that's why they jammed it so much after earnings. And you could jump on that yesterday if you could feel it. I mean, I tried shorting it, and I could feel, you know, when it was up like close to 41.80 or something like that, 41.70, and you could feel it. And, you know, I think I was pointing out earlier that I was looking for the breakdown on the, where's the 620 chart at? It always runs in highs just when I need it. Let's see. You get out of the way. Let's see. Here, I'll look under the skirt of this chart. Maybe this is it. Nope, that's not it. I know it's here somewhere. Here we go. Yeah, yesterday I was just waiting and waiting, trying to anticipate the 620 break where this 6-period exponential. So 6-period exponential would be 6 times 5 minutes, a 30-minute moving exponential moving average, and then this is the 20, the blue one, which would be 20 times 5 would be a 1-hour exponential moving average. So see, Grub's back above 44. Look out. But in any case, you never had a sell signal. Now we're getting one today. So finally, you know, maybe it's going to reverse and come in. So, but I can act on that. Right now, since I already shorted it up in here, and you notice when you look at the 5-minute chart here, and this is what, you know, I'll go into a little bit about the 620 chart, just so some of you who are watching and are new don't start getting some big idea that this is some magical system, because I don't believe that there is any magical system that exists anywhere in the market, regardless of what it is, and that includes this chart. Everything has to be taken within context and used as a tool more than something that you blindly follow. So just because you have a sell signal here, that's constructive in terms of being bearish or looking to short the stock, okay? it doesn't necessarily mean it's going to work. But the other thing you can see is just looking at the chart on a candlestick 5-minute chart here, you can see that you're getting resistance along here, and you see these little tails. So it's telling you that you can probably try a short in here, and that's around 44.75, and then you just use the high of the day as a quick stop, a bailout point if it doesn't work. And notice the Dow's off 37. I think we're going lower. We'll see. And at least you can pull back some. But at the same time, I still think you need to be proactive about taking profits when you have them. And I know people will, if they get away with being long, dumb and long, and they get away with it for a while, but in this market, they take away your gains very quickly, and I've seen that happen many times. That happened in 2000. Everybody thought, that everything was going to go up forever. But in any case, you have the 20 period, the 6 period dropping below the 20 period, which is basically a 1 hour exponential moving average, and the same settings are down here. Now, the only thing working against this that I would point out as a sell signal is the fact that you already crossed up here, and you're hanging along the lows here. So there's always a potential for this to turn. So it's a little extended on the MACD, so there's always a potential for this to turn up. Now, what could also happen is the MACD can't get above the slow line. So the fast line, which is the orange one, can't get above the slow line, and maybe the whole thing just turns lower. That's a possibility. But I think at this point, if I'm short up in here, then I'm in a good position, and I could probably use a 620 buy signal as a point to get the hell out of the way. So somebody's saying jump in or add to. If you have to ask me, then you shouldn't be shorting. Okay. I mean, come on, don't we go long enough or far enough in teaching people the methods and then trying to get you to exercise, because exercise your own judgment and be empowered, We got somebody who just became a new member, and they pointed out that they were getting this Minervini private access crap for $5,000 a year or something. And, my view is this idea that I have some magical knowledge and you can just follow my trading and I'm going to charge you a whole bunch of money for it is a bunch of baloney, because number one, it's not going to work that way. And number two, if I'm such a great trader, why do I need to charge people so much money for that? Why, if I'm focusing on my trading, can't I just make a bunch of money that way? And so, we sort of fight against that whole concept of sucking people into some idea that we've got some magic elixir for you to drink from if you just pay us enough money. What about the guy with a $10,000 account who can't afford to pay $5,000 a year or I know I started with like $3,500 back in '91. So could I afford to pay some goofball $5,000 for his private access? I don't think so. Anyways, what's your strategy for taking large positions? Well, I jump in and I take a large position at a point where I think I can get away with it. So I don't know what you're talking about my strategy is. Like there's some system, some magical calculation I make. Anyways, it's 9:59. We got like a couple more minutes.
Actually,
Go ahead.
on that question, a very important point is that if you're taking an oversized position, Bill O'Neill used to say, if you're oversized, you're going to do the wrong thing at the wrong time. So make sure it's still in line with your investment psyche, that you can take on an oversized position without it jerking you around prematurely, exiting prematurely. The second thing is keep in mind that in this market, if you're taking a huge position overnight, that position can gap up or gap down on you depending on whether you're short or long. So always keep that in this context. Always ask yourself, if this position were to lose more than 50% overnight, can I stomach that? Can I handle that given my position size?
Yeah, and that's basically what I'm doing. I mean, if I take a big position these days, I'm looking for a very quick pop, and also to get some cushion underneath me pretty quick. So that's my strategy. Give me a lot and give it to me fast. Anyways. Any other questions? No, I think that's it. So, Alan, I'm not sure what you mean jump in or add to. Didn't mean for shorting. Can you, I wouldn't add to something. If I have a big position, I'm not going to add to it if it's moving up. I'm not, in other words, if I've taken a big position, I take it all at once. I don't try and get fancy. So. See if Snap doesn't roll back. Starting to kind of you haven't had a 620 sell signal all day. You had a buy signal early in the day. You can see that, and now maybe you're going to roll back. So if the market rolls over, it probably will come in. So my point here is if you've been trading at, say, up the 20 level and you've got some nice profits, you might consider taking some of that proactively. Now use a trailing stop or whatever, but I think in this market, if you have gains, you might want to take them. Like, today, everybody who hated Amazon loves it, and I listened to Stuart Varney on Fox Business News, and he's just all over how great it is. And now it's great. When it was at 600, it's overvalued. So that was one of the things that inspired me to short it when I saw the 620 rollover here. Anyways, what else? Weibo's actually been on the comeback trail, and here's another example of a stock that's looking dead. Here's a late stage failed breakout here on the weekly chart, and it fails up here. You can see this, boom, right there, and then it looks like it's going to blow apart and head lower. Instead, it turns and rallies, and it does so on a bottom fishing pocket pivot. But notice how it fakes you out. It has one bottom fishing pocket pivot here, and then another one here. And this one fails, and this one works. So it's screwing with you. Basically, that's what it's doing. It's good flopping one way and then flopping the other way. And it sucks you one way, and then it sucks you the other way. And you get this in a lot of stocks. So that makes it tough to be big, I think, in terms of position size. And I think when you look at something like a Netflix, that's another stock that likes to screw with you, It's just jerking you around. Because if you look at this, and let's look at the objective evidence in real time. You get a heavy day of selling here. So that looks like trouble. You get a breakout back here, and that immediately fails with the volume picking out. So that looks like trouble. And then it breaks to lower lows on higher volume but below average, and that just sets an undercut and rally move. So if you're using traditional analysis, you might be thinking this is a bearish breach of the 20-day exponential moving average when it isn't. And then the stock turns around, and then it tries to break out, and you get the heavy reversal, outside reversal off the peak, but it just comes in, the selling sort of dries up here, it bounces off the 50-day line, and it goes back up and breaks out to new highs, but that doesn't hold, and it breaks back below the 50-day moving average, and then it turns back up to the highs, and then after earnings it breaks down, and it looks like it's going to blow to pieces, but it doesn't. It turns around and breaks out. So, how do you play this? You take a contrarian position when it looks like it's leaning too far in one direction, basically. When it looks beautiful, you sell your long and go short. When it looks ugly, you cover your short and you go long. And that would be a great strategy for Netflix, which tells you, if we could extrapolate that out, what is it telling you now? Maybe I'll short the breakout. I've been looking at it that way too. It's down, 75 cents? That's absolutely nothing on a day like today. But, that's what this market is like in a lot of cases. And, yeah, you get the Facebooks of the world just continue to trundle higher. It doesn't seem to matter. Even when it starts to look a little ugly, because we can see here, heavy volume reversal off the peak here, and then you break down, and it looks like you're living under the 20-day exponential, but then you pop out, and you just keep moving to new highs. Albeit it's only 8% or so higher, and it looks like a lot more than that, but it just keeps trundling higher, and that's where all the money is going. So it's almost like they're hiding in some of these big names. You see Priceline doing the similar sort of thing. Boom, it's going higher, even when it starts to look ugly. We looked at Apple and so on. Qualcomm maybe doesn't look so hot. Baidu got tagged, so I guess the deal with Netflix isn't good for Baidu, but it's trying to find support. I'd watch this as a possible short on a rebound. So you're getting a 620 buy signal. So if you shorted it this morning at 184, you got some nice juice on the downside. You get the MACD stretch, but you're crossing here, and now you're crossing at the 20 period line. But I'd watch it, see where it settles in. If it goes, maybe if it moves up a little bit and then rolls back over, you could re-enter. But that's was a nice short this morning as well. So I'm watching this one. This one is another one. It gapped up. Look at, and I watched this yesterday. It traded after hours. I think it went down to like 82, 83. And then I think you can see that after hours. When it got, here we go, down to 82, 83, down in here, after hours. And then they had their conference call, and the stock jacks to the upside. And then this morning it opens up It's going to open up right at the opening. Well, you notice you get a 620 sell signal early in pre-open around 92, say 92 and a half. Well, let's say 92, and it's gone lower since then. Now it's bouncing. You get the MACD stretch here and the cross, so it's bouncing. Yeah, that's a pretty good break. So as with Baidu, you could probably cover there and then see what happens at the 20 period. Notice how it got through, but now it's running into trouble again. So maybe it's going to roll back over and it's toast. So I think there's someone trying to be bullish on this thing or asking us before what we thought about this. But you know, ahead of earnings on Baidu, for example, you really can't tell what's going to happen. I mean, you had a nice tradable move before earnings. Now it's breaking. And this WDC, Western Digital, maybe this thing's going to stall out and fail. I noticed that, I think, was it Seagate? What's Seagate? STX? Yeah. They came out with earnings, and they were looking great, and then they just gapped down and blew apart. And that was a shortable gap down if you saw it. So, you know, there are opportunities that show up after earnings, and I think they can be long or short. I know Scrub going to 43.60 now. So that's busting apart, splitting wide open. I wouldn't be surprised to see that thing go down, you know, $7-8 from here. Anyways, that's you know, so it's not an easy market, I don't think. And so, you know, I'm just looking for the next place where I can make big money, and it's been a little bit difficult. So, in any case, that's all I've got. Dr. K, you got anything?
No, I think it's you know, keep to the course, keep to the uptrend, but don't get complacent and keep your stops tight as always.
Okay. All right. Well, that concludes this episode of the VoSI weekly webinar, and we'll catch you guys next week. Have a great weekend. Take care.
So long.